Hey everyone, me Kevin here. In this video, I'm going to break down a set of top trades that you want to keep an eye on going forward in the next few days and weeks. Now, I want to be super clear here. These are swing trades. Some of them are trades that I might actually hold longer, but I want to be clear, this video is different from my typical fundamental analyses videos. These are more interested in looking at market swings. So let's talk about the first one. But of course, first I have to remind you to get $30 totally for free with M1 Finance. Deposit $100, get 30 bucks. Boom pow, yeah. And deposit $100 with Webull and get at least $21, if not up to $1,600. Links down below. Let's go. So let's talk about the first one. A continued run on GM. General Motors has a market cap of $78.4 billion and sold 7.7 million vehicles in 2019. NIO, on the other hand, sold 43,000 cars in 2020, so literally 1/2 of 1% of the cars that GM sold, and has a $91 billion market cap, which is about $13 billion larger than GM's. Today, Microsoft announced that it is partnering with GM's Cruise technology with a mega $2 billion investment. Cruise is GM's driverless startup and has a very similar name to Chevy Super Cruise, which is kind of like the autopilot on Tesla, except for Chevy and Cadillacs. Chevy Super Cruise only works on mapped highways and has a little camera on the dashboard that watches your eyes to make sure you're paying attention. Well, that same technology is created by the company Cruise, which is a company that GM bought. Tesla, keep in mind, makes you jiggle the little wheel to make sure you're paying attention, which means a lot of people don't actually pay attention. Lucid, by the way, I also just discovered, also plans to use the little camera to make sure that you're paying attention on the dashboard. So we'll see how that goes. But anyway, the Cruise startup alone right now is valued at around $30 billion, which if you subtract that from GM's market cap, that's like almost half of GM's market cap right now. Cruise is going to be using Microsoft's Azure cloud platform to help get Cruise to driverless vehicles and eventually, wait for it, robotaxis. So really, about 40% of every dollars that you're investing into GM right now are potentially going right into Cruise, just based on valuation metrics here. And to me, GM here could actually be a modern kind of competitive play against Tesla and Google's driverless Waymo division in, a few years from now when they actually start getting to autonomous vehicles on the road. Not now, but we're starting to see that EV excitement go over to GM. We're seeing that stampede run over to GM. GM last year was up like 14%. The thing's up like 20% this year, and we're only 19 days into this year so far, with way less trading days in. Now, keep this in mind, recently the RSI is through the roof. So if you're looking at trading technicals, it's like, oh, come on, man, this thing is overbought. This thing is like, how can we buy this thing right now? But folks, that EV rage and this realization of the size that Cruise is relative to GM as a company itself, it kind of justifies this right here. We'll see how this goes, and volumes through the roof over here in the last few days. But basically, GM is becoming a Biden play. And honestly, it's probably better to throw money at GM than to throw your money into some crazy EV SPAC that could end up nickeling out, because there's so many EV SPACs that just aren't actually producing products yet. Sure, look, I might be excited about Lucid, but you gotta have like balls of steels to go in deep on Lucid because they haven't actually sold a single car yet. So if you're nervous about the EV, you're looking for something a little safer, $30 billion market cap built into GM here on Cruise technology, that's really interesting. VW on the other hand, get this, VW on the other hand, they had insane excitement in Germany over, yay, we have the VW ID.3, and yay, EV sales are doubling in Europe in 2020, and yay, the ID.3 is so cool and awesome. But the Wall Street Journal just destroyed Volkswagen for all of the problems the ID.3 is having because it's been plagued with software issues. And this is where there's actually a big lesson about GM here. Regarding Volkswagen, they say, quote, what they didn't consider, electric vehicles are more about software than hardware, and producing exquisitely engineered gas-powered cars doesn't translate into coding savvy. Whew, Really good line there. But again, what makes GM different from Volkswagen in this case? Well, what makes it different is the fact that GM bought Cruise in 2016 for $1 billion. The company had 40 employees then. Now, Cruise has 2,000 employees. GM is literally, well, Cruise, the part within the umbrella of GM, is literally becoming a mega powerhouse of autonomous innovation right now, right in front of our faces. You cannot short GM. If anything, you want to spend some money and you want to go shopping today, whenever you watch this video or next time the market's open, folks, call options on GM are looking a little juicy. And again, the stocks run up, so I don't know that I would go with anything super short term, because in the super short term, we know when we've got an overbought, we can always go right back down. The market's really good about punishing us when we chase the woo, unless you're just like really lucky with the timing. But folks, GM, pay attention to this one. The size of Cruise within GM blew me away. Okay, next up, folks, EXPI, the online work-from-home real estate broker. Folks, this pandemic has accelerated a shift to working from home. Duh. I don't think any of y'all can disagree with me on that. But most people don't even know what the hell EXPI is. And I should have said HE double hockey sticks, but I'm that passionate about this. People are clueless about what EXPI is. What if I told you that EXPI, that's the ticker symbol, or EXP Real Estate, was a company that basically let you hang your real estate license, if you were a real estate agent, with a virtual brokerage where you could attend virtual training sessions and basically never have to set foot into a traditional office again. You could literally work from home doing YouTube videos naked or in your underwear. I'm not, I got pants on, but you could. and you could still be a real estate broker. Well, that is the beauty about EXP. It has jumped on the revolution of working from home and normalizing being a real estate agent who works from home and who doesn't work for an office. I am a real estate broker. I get this model. People are always like, oh, Kevin, but don't you got to have an office as a real estate agent? No way. Anytime I take meetings, I either meet at my client's property, if they're a seller, or my buyers I meet for coffee, or even new sellers I meet for coffee sometimes. Why? Because I can buy them whatever I want at Starbucks or Coffee Bean. Now, things have been a little different during the pandemic, but you got to eat and drink outside most of the time. But the point is, EXPI, guess what they just announced? 2-for-1 stock split. I first recommended this stock to all my course members when it was around $41 per share. Right now it's at about $81 per share. Now this is that's about double, okay? But it's about to go back to what we bought it for via a 2-for-1 split, which is awesome. The split is scheduled for January 29th. Technically, this changes nothing for the fundamentals of the company, but what it could do is finally bring that Wall Street attention to EXPI that it really deserves. EXPI is a game changer. It's revolutionary. Really excited about that company long term. And I have to say, I would love a little bit of Wall Street attention to one of these days look at Shift stock. If you haven't looked at that one yet, I feel it coming, and the data we are looking at as course members that we've been looking at in the last few days reiterates that Shift is a buy. This is a bonus one. I'm not going to go deep into the data in this video. Maybe tomorrow's video we'll talk about that one more deeply. But look into ticker symbol SFT, Shift Technologies, folks. The metrics are looking so good. The website analytics, the analytics on the business model, the inventory models. I'm liking where that company could potentially go once it gets that Wall Street attention, which at the moment, I think EXPI is going to be getting. That is, of course, next to Gevo. Gevo. Holy smokes, this stock is up over 72%, giving up just 7% in after hours so far, but wow, what a riot. I talked about this stock being a potential up-and-comer in my course live streams last week, and boy, oh boy, many of you were like, Kevin, I see the momentum, and you jumped in. And hats off to all of those of you who jumped in as momentum traders. You nailed it on this one. You nailed it big time on this one. It's kind of like all those of you who, when last week in the course member live stream, I'm like, you know what's looking really juicy right now? AMC call options, because it's like at the lowest price it's ever been. And the last time I did AMC call options, I made a buttload of money on it. And both of these trades were trades that I was too much of a baby to make because I decided, I'm going to pay off margin this week. I want to reduce my margin. Otherwise, I would have made these trades. But no, Kevin had to pay off margin. Anyway, congratulations to those of you who actually pulled the trigger on those trades, even though I was somewhat not in the mood for them at the moment. So congratulations again. I'm glad we were able to talk about them though, and I was able to bring them to your attention. Now, Gevo, let's talk about this one going forward, okay? Gevo, this is a company that is pretty much a pure Biden play here. It manufactures biofuels for planes like ethanol. Donald Trump was not really good for a company like Gevo because Donald Trump is very pragmatic in that, look, if something's going to increase the cost of cars or airplane rides, I don't want it. That's pretty much Donald Trump's MO. Gevo is a name that has secured an Air Force contract in 2012. It's a name that has an agreement with Delta to supply 10 million gallons of fuel for the next 10 years per year. It's a company that right now has 48.6 million gallons of SAF, or Sustainable Aviation Fuels, under contract. We'll just call those SAFs for now. And potentially another 35 million gallons in contract review, plus another 251 million gallons in discussion. So right now, if we just tie together the gallons that they have under contract in the final stages, we've got about 83 million gallons of this SAF fuel that Gevo might be producing. That's enough for about 224 10-hour flights. That's, I mean, that's okay, but it's relatively nominal compared to the amount of flights that we see that are, you know, all the flights going on throughout the world. So it's a small number, which potentially sets Gevo up for a huge addressable market if SAFs become more, well, cheap. See, right now, the SAF market share is so teeny tiny because oil is just dirt cheap right now. Oil costs somewhere around well, I should say jet fuel costs somewhere around $1.48 per gallon right now. SAFs, way more. Back when the military did a contract with them, SAFs were selling for somewhere around $58 per gallon. Back in 2012, there was talk that, hey, you know, for this to actually go mainstream, we need Gevo, you know, SAF fuel basically, to get down to $3 a gallon. That was back when oil prices and airline prices, or airline fuel prices, or jet fuel prices, were around $3 a gallon as well. Well, now Gevo is struggling to get their production costs under $3-ish per gallon based on their latest filing where I found that they talked about this. And we'll talk about that more in a moment. But the problem is, even though back in 2012, jet fuel was selling for like $3 a gallon, and they're like, okay, let's get Gevo down to $3 a gallon in cost. That's great. Well, cool. That'd be wonderful. But now oil prices have fallen even more. It's hard to justify paying extra for Gevo. And even if Gevo can produce SAF, again, the Sustainable Aviation Fuel, for $3 a gallon, doesn't mean they can sell it for $3 a gallon because they got R&D, they got staff, they got administration. To be profitable, they have to sell these like fuels for like $10 a gallon. So why on earth would an airline pay $10 a gallon if they could get, you know, regular jet fuel for $1.50 a gallon? Like, it's insane. You would need an insane amount of subsidies to actually convert a fleet. Like, you wouldn't. You would only do a little bit to have the marketing impact of, yes, we use some sustainable fuels. And that's kind of what I think is happening with Delta. Delta, by the way, this is interesting math here. So Delta is planning to buy 10 million gallons of Gevo fuel per year for the next 10 years. That's 10 times 10, that's 100 million gallons. Well, Delta values this deal at $1 billion, which kind of implies that Delta's paying around $10 per gallon for the Gevo fuel, which again, reiterates, folks, the airlines, especially at a time like this, and that Delta contract was made before the pandemic, so it'd be interesting to know what the latest is on that contract. So far, I wouldn't be surprised if it's all on hold. But anyway, this stuff at $10 a gallon, it's literally liquid gold. So why are we even talking about Gevo? Why the heck is Gevo up 72% today? Well, folks, the only reason is because Gevo fell onto the radar because Gevo's co-founder, Francis Arnold, was named by President Biden to Biden's science team. That's it. That's literally the announcement that took this $500 million market cap company and basically almost doubled it. That announcement right there has a lot of people very, very excited about Gevo. I personally am very, very concerned about that price disparity because even if Biden comes in and says, hey, look, we'll do a 20% incentive, we'll just print money for Gevo or SAF, you know, Sustainable Aviation Fuels, folks, still, okay, $8 to $150. Come on, man, I'm not converting my fleet. It's going to be a lot of money printing, or I ain't buying it. we'll see. The alternative is Gevo could also get their production costs down substantially. And I think that's the goal, is if Gevo can get their production costs down substantially to be more at parity with oil, great. Unfortunately, the whole EV movement is reducing demand for oil, which makes that even harder for Gevo. So you've got really a lot of kind of polling in different directions here with Gevo. For me, if I was in Gevo right now, I'd probably ring the bell and take profits on this one. I'm very happy. If you made money on it, I would ring the bell, make the money, get out of there. Usually I don't recommend selling. I can't count Gevo out though, because honestly, during the inauguration tomorrow, Biden could just go up there and go, we're gonna make biofuels the #1 fuel ever used, and the stock's just gonna keep going to the moon. So be careful, pay solid attention to the inauguration, because this could be big, but for right now, it feels more like a 10-year out hydrogen play than this is big for tomorrow, with the exception of hype and speculation, which is definitely driving the price right now. So be careful on this one. I would take profits on this one. Still think it's a great company. Don't get me wrong. Still think the technology, the service they provide, and their mission for the world, good. In terms of price action, scary. Good if you owned it. Not so good if you want to get into it. Next, folks, Shopify. A little nervous about this one. So I'm seeing, look, Shopify, so cool. Like, entrepreneurs tend to prefer, online entrepreneurs at least, tend to prefer Shopify over Square, but the business entrepreneur, the person who has the, ground location, prefers Square over Shopify because they integrate better, blah, 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 blah. Shopify's competing with, Square on this, whatever. Y'all have your own opinions on Shopify versus Square, and I know that. And many of you all are like, Kevin, we know you're more bullish on Etsy than you are Square and Shopify combined. And that is kind of true. But I do like Square a lot better than I like Shopify. But I still like Shopify. One thing that I want to say, though, is take a look at this. This made me a little nervous, okay? So I'm going to jump on over to this chart right here. So what this chart shows us is SquareUp, this is the website you go to when you want to sign up for Square. It actually redirects to square.com. Anyway, Square, from July, we've got this nice growth here, right? This is good. Then we've got, just for comparison here, I threw in Squarespace, which, it has its little ups and downs, but it's also kind of been trending up here. So we like Squarespace, again, just comparing to Squarespace. Then, something that's very interesting, and this is the more important aspect to consider when we look at this chart right here. So really, out of everything, this is what is interesting to me, is why is it that Shopify.com is actually showing a little bit of a decline right here, but not only that, we've also got a little bit of a flattening at the My Shopify URL, which My Shopify is usually where people log into their store. So look, the store logins are kind of flattening a little bit on website ranking here, and the Shopify sign-up data is kind of slowing down a little bit. Again, this isn't a Square video, so we don't have to care so much about Square.com versus SquareUp and all this kind of stuff. Right now, we just want to focus on Shopify, and to me, as a short-term metric, I thought that was a little bit of a head-scratcher. Why is Shopify showing that? Why aren't we seeing more growth with Shopify? There is an argument that maybe, Shopify is potentially not as much of a recovery trade as Square is. Think about it. Square is a reopening trade. It's a Bitcoin trade. It's a stimulus trade. Right now, you've got all of those happening. Shopify is more of a little bit more of maybe that stay-at-home stock, right? Let's go ahead and pull up the chart really quick on Shopify here. Now, I'm going to jump over to Google really quick just to make a very simple observation here. But Shopify kind of been flat, relatively flat since August. We're about that 8.39%, right? Square, on the other hand, it could be argued that since August or the end of August here, Square's already been baking in some of these gains we might be expecting to see, 36% increase. So definitely a lot stronger action here on Square. And then Shopify, which makes us wonder, when is that next Shopify breakout going to happen? Because 2020, look, we had a really great movement between the crash and July. But since July, even 13%, it's been a little bit of an underperformer. So is it possible that Shopify is going to surprise us Totally possible, because just because subscriptions didn't go up to the moon or more people aren't using the website doesn't mean that revenue isn't up substantially. So we'll have to see what the turnover ratios are at Shopify. We'll have to see the initial chart. Just looking at that little bit of data there, the initial chart makes me scratch my head a little bit more on Shopify. It does kind of make me think of Netflix and Disney a little bit, though. Folks, look, I mean, Netflix, okay? Netflix did nothing since July either. It was down 4% since July. It's up 12% in after hours because they just blew expectations out of the water. So it's entirely possible that Shopify could totally surprise us. That little bit of data I see there doesn't make me excited. I'm gonna keep looking for data, though, before Shopify earnings. But it's definitely something to keep an eye on. And just to make sure we're comparing as much as we can like for like here, when I looked at Netflix's data, folks, Netflix's website analytics were up. Their time on website was up. Their overall bounce rate was down. That's a good thing for Netflix.com compared to what we're seeing at Shopify. So a little nervous on that one. Now, people are wondering, Kevin, should we dive into Walt Disney because Netflix is up? I think Disney's already given its big jump over here. It's 10% bump due to Disney Plus really killing it over here at the beginning of December. We'll see how this translates when Disney ends up reporting. But folks, Disney and Netflix, honestly, both of these, and even Shopify Square, these are companies you can own blindfolded forever. Disney is a company that I love so much because you've got this built-in recovery play plus the Netflix, right, via Disney Plus. You've got both of that kind of built in. The hotels, the theme parks, the high-quality cruise lines, very expensive cruise lines. Once those things get cruising again, and you get the Disney Plus blowing up, whew, I mean, there's some real potential at Disney. In my opinion, if Disney's undervalued, or if the market's looking for an undervalued company, let's put it this way. Disney might be one of those because it still trades with that old school valuation. It still doesn't have that Netflix valuation. But we'll go deeper onto Disney in a different video. These are just ideas here. So let's move on now. Okay, the last one. United. United Airlines reports earnings tomorrow after the inauguration. They are losing money like crazy. They're pretty much expected to miss earnings. And Delta missed earnings this week, although their stock did go up a tiny little bit after they missed earnings, which that's the weirdness of the market. But this might also potentially be because airline executives are really talking down airline travel right now. They're complaining over lockdowns. They're complaining over COVID. They're complaining about a lack of travelers. They're complaining about, anti-maskers and what about, what happens if Biden comes out with these mask mandates that are potentially more stringent? Who knows? A lot of potential issues at the airlines. But what do we do with United? This one's a little up in the air. I don't have strong conviction on this one either way. I personally first would recommend one of the things that you should totally do is track traffic. Do that by going to metkevin.com/TSA. You'll be able to see the TSA passenger data. I would write that all into a spreadsheet, download that table if you can, put it all into a spreadsheet, get that data analyzed. I don't have as much high conviction on these airline stocks. They make me a little bit more nervous. If I was going to get into these airline stocks, I would probably recommend jumping into something like Jets. That way you could get the airline ETF. With Jets, you get 9 to 10% exposure to Southwest, Delta, United, and American each. Plus, you get some exposure to Spirit, JetBlue, and others. Some people say, hey, Kevin, look, maybe go all in on Spirit. I have to say, website data between United, Delta, and Spirit shows Delta and United actually doing better. And one of the arguments, or one of the issues we had originally when the pandemic started is we thought, and I remember we talked about this in the course live streams, one of the issues we thought was, look, Spirit's great as a low-cost airline, and people are going to want to save money, but there's going to be so much competition from Southwest, Delta, and United, and American, that what's going to happen is those companies are going to lower their prices. And when they lower their prices, you really take away the whole aspect of, oh, come to Spirit, we're a discount carrier. Sure, you might be a discount carrier, but I can get a normal carrier at a discount now, right? Once they start getting more of their planes flowing in, then you got wider seats, you got the tray table that you can actually put your arms on without falling off. So some potential risks there. This is why, you know, with the airlines, ooh, just such a tough sector right now. Probably be more interested in jets. Anyway, those are my thoughts. Those are my trading thoughts, the things that are on my mind. If you liked this sort of Meet Kevin's thoughts on trades, this is like totally the opposite of what I ordinarily do, because I usually talk fundamentals. But here's the thing, when I research my fundamentals, I usually sit there and I'm like, ooh, that'd be a good trade. If I were gonna trade, I'd do that. And then like usually 2 days later, I'm like, damn, I should have done that trade. But I've had my head in sort of the sand of fundamental buying mostly. And I don't think that's a bad thing. I think based on my schedule and my workload, I think that that's very common. But hey, when I come upon these ideas through my fundamental research, like the GM Cruise, I think honestly the size of Cruise is still a little bit, you know, under wraps, but that's powerful. But when I come upon these things, I want to share these ideas with you. And then of course you can make your own decisions. I don't want to tell you to trade a certain way or another. I'll give you my opinions where I can and give you some thoughts, but folks, these are all things to pay attention to. So thank you so much for watching. We will see you in the very next video. Thanks for being here. Consider subscribing and sharing the video if you found it helpful. Thanks, bye.